All right, so let's go ahead and start with those fundamentals of inventory. So if we remember in chapter 6, we were introduced to inventory. So these are items held by a company for the purpose of resale. Right? And we said we're focused on merchandisers, right? Those merchandisers, they buy the goods from their supplier, and then they hold on to that inventory with the purpose of selling them to their customers, right? So inventory, it's important for us to keep track of the cost of, because when we make the sale to that customer, we know our journal entry was AR and sales, and then we had that second journal entry to record cost of goods sold and the inventory, leaving our store customer, right, and increasing that cost of goods sold. Now, if you remember in chapter 6, these figures were all provided, right? Now in chapter 10, we will be solving for those figures. We will solve for those amounts. And we will solve for the cost of the inventory that we sold using one of 4 methods. Okay, those methods are first in, first out, last in, first out, weighted average, and specific identification. Okay, specific identification is very straightforward in how it is calculated. So I'll let you read through that method on your own in the chapter. I'm going to focus on the first 3. The first 3 are what are called cost flow assumptions. Cost flow assumptions. Whereas specific identification is not. It is an exact measurement of the costs as they leave. Okay, cost flow assumptions, FIFO, LIFO, and weighted average, basically means maybe we purchase our goods, right? The first goods that we purchase, the earlier purchases, right? Maybe we sell them, the earlier purchases first. That's fine. Think of like a grocery store. They're worried that their goods might go perishable, right? They might perish. So the very first produce, dairy items, the very first items that they buy, their earlier purchases, they try to sell those first because they don't want to have a loss dealing with the item going bad. Okay, so that's an example of like first in, first out. But what it's saying here is even though maybe we sell in a first in, first out method, we could pick LIFO to track the cost of our inventory. It doesn't need to actually match the flow of sale of our units. Okay, I mean, it kind of makes sense. There's no way for us to track costs in a weighted average method, right? You can't say, oh, hang on, don't buy that carton of milk. I have to chop it up and give you the average of another bottle, right? Half of this bottle, half of that bottle, right? So there's no direct correlation that must be met in the way that we actually sell our goods and the cost method that we use to track the cost of it. All right, so the next slide, I'll give you a high-level overview of the first 3 options, the first 3 methods.